most profitable company of the AI boom trades at 4.8 times earnings. The biggest foreign listing in U.S. history is the bet on Y. On July 10, 2026, the chairman of one of Korea's biggest conglomerates stood on a podium in New York and rang the Nasdaq opening bell. Shi Tae-won called it, "truly historical moment" and "dream come true." The occasion earned the language as Hynix had just raised $26.5 billion in the largest U.S. share sale ever made by a foreign company, with demand during book building exceeding the available shares by more than 7 times. And yet the most interesting number of the day was not the $26.5 billion. It was a small, almost embarrassing ratio sitting underneath the pricing 4.8. That is how many times its forward earnings the world's leading supplier of AI memory was trading at, while the median chipmaker in its industry traded at 29.84 and its closest American rival at 6.6. The most profitable company of the AI boom was priced like a business in decline. This episode is about that gap, where it comes from, what $26.5 billion is supposed to do about it, and what the first weeks of trading actually showed. The ratio has a name, and the name is an accusation: the Korea discount. South Korean companies tend to trade at lower valuations than their global peers, and the reasons usually cited are corporate governance and the opaque structures of the conglomerates that control them. For SK Hynix, the discount reached absurd proportions. LSEG data put the company at 4.8 times 12-month forward earnings, against an industry median of 29.84 times, and against 6.6 times for Micron Technology, the American rival it outsells in the market that matters most. Analysts offered a gentler diagnosis than governance access. U.S. funds found Korean shares genuinely hard to hold. A local account, currency conversion, local settlement. Dave Madza of Roundhill Investments argued the company suffered from an accessibility discount rather than a quality discount. The listing was designed as the public test of that theory: put the same company on the Nasdaq in dollars, one click from the deepest pool of capital on Earth, and let the market say what the discount really was. What the discounted company actually does is sit at the choke point of the AI build-out. SK Hynix is the world's leading supplier of high-bandwidth memory, the stacked chips that feed data to AI accelerators, and it held roughly 57% of that market in 2025. The explosive demand for HBM has far outstripped the industry's ability to supply it. A portfolio manager called the company something of a victim of its own success. The scarcity shows up in share prices. Over the course of 2026, Micron surged nearly 250%, SK Hynix 204%. It shows up in the order book too. The company has finalized long-term agreements with around 10 customers, locking in supply for years ahead, and began mass shipments of HBM4. The next generations. In the second quarter, when demand exceeds supply, the seller stops competing on price and starts choosing its customers. That is the position this company was in when its chairman walked up to the bell. The quarter that justified the frenzy arrived on July 28. SK Hynix reported revenues of just over 79 trillion won for the second quarter, with operating profit of just over 60 trillion won, an operating margin of 76%. Revenue was up 2.7% year-over-year. Operating profit was up 57%. Cumulative revenue for the first half crossed 100 trillion won for the first time in the company's history. For scale, in the same quarter 1 year earlier, revenue was just over 22 trillion won. The business more than tripled in a year, not by shipping vastly more chips, but by selling the same scarcity at rising prices. Both DRAM and NAND flash prices rose sharply quarter over quarter, and the mix shifted toward the high-value products. HBM DRAM for AI servers, where the margins live. A 76% operating margin is not a manufacturer's number. It is what pricing power over a shortage looks like, for exactly as long as the shortage lasts. And further down the income statement sits a number that reads like a misprint. Net profit for the quarter, more than 93 trillion wons. A net margin of 18%. The company reported more profit than revenue, with net income up 242% from a year earlier. A margin above 100 means the bottom line was carried by more than operations alone. The release does not itemize it, and the figures remain subject to the independent auditing process. The balance sheet is less ambiguous. Cash and cash equivalents reached 88 trillion won, up 33.6 trillion in a single quarter. Total debt fell to 18.6 trillion. The net cash position 69.4 trillion won. Read that against the headline of the listing: the company that just raised 26.5 billion abroad was, by its own balance sheet, already sitting on the largest pile of money in its history. And it raises the question the analysts asked out loud: why raise anything at all? S&P Global's answer: the money is almost beside the point. The capex is forecast at 50 trillion won to 70 trillion won annually over the next 2 years, and the company is expected to generate over 200 trillion won in annual operating cash flow across the same period. The vast majority of the expansion will be funded internally. What the listing buys is not capital. It is access. American investors who could never easily hold Korean shares can now buy a dollar-denominated receipt under the ticker SKHY. The proceeds themselves go home. The first fab at the Yongin Semiconductor Cluster, an advanced packaging facility, extreme ultraviolet lithography equipment from suppliers such as ASML, And the sum is macroeconomic for Korea itself at 26.5 billion is comparable to nearly 80% of the country's June trade surplus, and exceeds the 9.9 billion the Bank of Korea drew from its dollar swap line with the U.S. Federal Reserve during the 2020 pandemic, a single-share sale large enough to move a currency. The debit itself delivered. The American depository receipts were priced at the $149, opened at $170, and closed their first Friday at $68.01, about 13% above the offer. More than 106 million ADRs changed hands in a single session. Each receipt represents 1/10 of a Seoul-listed share, and by the close, the New York paper was worth roughly 16% more than the equivalent shares in Seoul. And that premium is the whole experiment in one number. The same companies, the same earnings, value 16% higher for being easier to buy. Seoul noticed, and Seoul hesitated. The Korean stock rose more than 5 Fridays session during then, reversed to close 0.27% lower, at 2.18 million won. New York was paying up, Seoul was not following. It left two prices for one company. And the gap between them is the most honest measurement of the Korea discount ever printed. In an efficient market, the gap should closer buy the cheaper share in Seoul, sell the dearer receipt in New York, repeat until the two prices meet. But that machine only works if conversion between them is easy. And when conversion requires approvals or takes time, new ADR supply cannot reach the U.S. market quickly, and the premium can persist. There is precedent, and it is not obscure. Taiwan Semiconductor Manufacturing Co., whose U.S. receipts have often traded above its Taipei shares when conversion limits weakened arbitrage. The governance critics add the sharper point. Easier access does not change a company's earnings, assets, or governance. And the Korea Corporate Governance Forum argued that a lasting re-rating would require stronger board independence and more transparent capital allocation, criticizing, pointedly, that Tae-One announced a 100 trillion won investment plan before the board of SK Hynix had formally approved it. The discount, in other words, may not live in Seoul's brokerage paperwork. It may live in the boardroom. The whole structure rests on one macro bet, and the chairman stated it plainly. The memory industry has undergone a structural shift, Che said after the listing. The pace of demand growth is far outstripping the speed at which we can build fabs and expand supply. If that is true, the record margins are not a peak, but a new baseline. And the capacity being built at Yongin arrives into a shortage that never quite closes. But history advises caution. Memory makers have repeatedly expanded near the top of a cycle only to face falling prices when the new supply arrived. And competition is coming. SK Hynix's share of the BM market is expected to decline from roughly 7% in 2025 to around 50% in 2026, and into the low 4% range over time as Samsung regains ground and Micron cements itself as the third player. The bet is not whether the rivals catch up. It is whether demand stays far enough ahead that catching up never matters. The two columns, then. On one side, the operating reality is 76% margin, 100 trillion won of first-half revenue, a net cash pile of 69.44 trillion, and customers signing multi-year contracts for chips that do not exist yet. On the other, the valuation 4.8 times earnings for the leader of the boom in an industry priced at 29.84, a discount so wide that a 26.5 billion listing in New York was easier than repairing it at home. The test now runs in public in two prices every trading day. If the U.S. premium holds and the Seoul shares rise to meet it, SK Hynix becomes the model for every Korean company seeking global capital, and the discount was mostly a story about access. If New York keeps valuing the same company higher than Seoul does, the discount was never about brokerage accounts. It was about governance, and no ticker symbol repairs that. The market has rarely offered a cleaner experiment: one company, two prices, and a gap that will tell the truth on its own schedule. The ledger stays open.